The 2026 market is not defined by a single narrative. It is shaped by macro transitions, shifting liquidity conditions, evolving monetary policy, and ongoing capital rotation between asset classes. In this environment, Bitcoin and gold are no longer viewed as separate instruments. They represent two different responses to the same question. Where does capital go when uncertainty increases? For traders analyzing the market through a GrandAxisWay perspective, BTC and gold are not competitors, they are signals of changing macro conditions. Bitcoin remains one of the most reactive assets to global liquidity and risk sentiment. During expansion phases, BTC tends to attract capital due to high volatility, growth potential, and narrative-driven demand. Key structural levels for Bitcoin in 2026 are not just technical, they are psychological. Zones where liquidity clusters form, previous accumulation occurred, and institutional interest becomes visible. These levels often act as pivot points between momentum and consolidation. However, Bitcoin's strength is also its weakness. Rapid upside is often followed by aggressive corrections, especially when macro conditions tighten. Gold operates differently. It does not rely on growth narratives. It responds to inflation expectations, currency devaluation, and geopolitical risk. In 2026, gold continues to function as a stability anchor in portfolios. Key levels in gold are typically slower to develop but more structurally significant. Breakouts in gold often reflect deeper shifts in market confidence rather than short-term speculation. While Bitcoin reacts fast, gold reacts meaningfully. The relationship between Bitcoin and gold reveals how capital interprets risk. When markets are risk-on, capital tends to favor BTC. When markets shift toward uncertainty, gold becomes more attractive. However, 2026 introduces a more complex dynamic. In some scenarios, both assets can rise simultaneously, particularly when fiat confidence weakens, inflation expectations remain elevated, and liquidity conditions are unstable. This dual movement signals a broader macro concern rather than simple risk preference. Levels in BTC and gold are not just price points, they reflect behavior. Support levels indicate where buyers previously stepped in. Resistance levels show where supply becomes dominant. Breakouts signal shifts in sentiment. The important distinction is context. A breakout in Bitcoin during strong liquidity expansion is not the same as a breakout during tightening conditions. Similarly, gold breaking resistance during geopolitical stress carries different meaning than during stable periods. Levels are only meaningful when combined with macro context. Successful traders do not treat Bitcoin and gold as isolated trades. They view them as part of a broader system. BTC for volatility and growth exposure, gold for stability and protection, both as indicators of capital behavior. Rather than predicting direction, the focus shifts to interpreting movement. This includes monitoring macro events, tracking liquidity changes, and understanding market sentiment. The edge comes from alignment, not prediction. The real takeaway from the GrandAxisWay Market Outlook 2026 is not where BTC or gold will go next. It is understanding why they move. Markets in 2026 are driven by capital rotation, macro uncertainty, and structural transitions. Bitcoin and gold are simply reflections of these forces. One moves fast, the other moves with conviction. Both tell the same story just in different ways. Why are Bitcoin and gold important in 2026? They reflect investor behavior during uncertainty. Bitcoin represents growth and volatility, whilst gold represents stability and protection. Can BTC and gold rise together? Yes, in periods of macro uncertainty or weakening fiat confidence, both assets can attract capital simultaneously. How should traders use BTC and gold levels? Levels should be interpreted within macro context. Price alone is not enough. Liquidity, sentiment, and economic conditions must be considered.